Brian, I think that a lot of people watching these videos may own businesses and they're wondering how they should value their businesses, what they're really worth. There are basically two ways to do that, right?
Yeah, and as you mentioned that, it comes to mind there's also people wanting to value their business to sell it. There might be somebody watching this that wants to buy, because every time you have a seller, you have a buyer. So
Right.
this could be for either one of you. But yeah, there's two primary ways. One is a gross valuation, maybe an industry standard based upon your revenue. I'll just throw my own types of businesses in there. A CPA firm, maybe they average 1 times gross revenue. So if the annual gross revenue was $1 million a year, that firm is worth $1 million to a buyer. So that's a gross valuation. It's simple, easy to compute. We know what it is. A lot of CPA firms have been transacted like that. So that's one way of valuation. But I would say that that's not necessarily a great way. It's not necessarily reflective of, well, what are your expenses? I mean, that's fine. It's, you know, you're bringing in $1 million. Do you pay $900,000 in payroll to get that work done, or $100,000? I would care. And so the one that takes into account the net profit is something called EBITDA, earnings before interest, taxes, depreciation, and amortization. So you take your net income, you add back income taxes, depreciation, amortization, interest, to get to your adjusted net profit. It will be a multiple of that profit. So that's the typical way of doing a valuation, is to say, you know, a business is worth a certain multiple of their net profits, and different businesses have different multiples on that. But that's the building block of where to value a business.
Brian, I know that here at Madrona you deal with a lot of business owners. Do many of them really have this information of what their EBITDA really is?
Well, no, and I think the first step you have to do is figure out whether you even have a business to sell. So one of the adjustments I would make to that first building block of EBITDA, let's say that you say, all right, my business makes $200,000 net profit a year. I say, okay, what's your business? I have a law firm. Okay, and how much do you pay yourself out of that? I don't pay myself. Okay, but you make 200. Yeah. How much would it cost to replace you with an attorney that can do what you do? 200,000. So, well, my adjusted EBITDA says your 200,000 profit is what it would take to replace you. You're really making nothing. You have a job, your own job. When you leave, that job goes. You don't have a business. You don't have any goodwill. Goodwill is created when you take yourself out of the equation, replace yourself with some kind of salary or whatever for your replacement, and then look at that net profit. If there's net profit still there, you might have a business. You might have goodwill. You might have something you could sell someday, but a lot of people don't even have something to sell.
Would it be fair to say that you have a saleable business if that business could operate without you being there?
Yes, if it can operate at a profit. So that's where we have to get to, is what's that profit. Now, the more predictable that profit and the more recurring that profit, the higher the valuation might be. So if I have a business that, you know, I sell real estate or something, and one year I have great sales, one year I don't, they're all one-off sales, there's really nothing to sell there. There's no predictability there. But if I had another business where, you know, every month I could tell you next year about what my sales and profit's going to be, because it's recurring, I know what's happening, I know exactly what it is, the more predictable it is, the higher that multiple can be.
How long does a business have to be in business before you can accurately put a valuation on it?
Well, any business can have a valuation. Now, not all businesses sell on EBITDA. A lot of them sell on the potential of EBITDA. So you take a look at the stock market. For years and years and years, a company like Amazon or Microsoft, they weren't making any profit. They were losing money. But the anticipated profit was there. And so, but most of the businesses that I'm talking about, long-term, small businesses, we know what we have. We're not inventing new products and procedures and all that kind of thing. Most of them we would look at to say, okay, if I was a buyer of that, could I count on a certain amount of profit per year? And if I can, okay, maybe I'll pay you, you know, 6 times that profit or 8 times that profit, whatever it is. And the bigger that business, the higher the multiple typically.
So if the business has been, operating for a year or so, that may not be long enough to put a value on it, but if it's been in business for 10, 15, 20 years, that is a better length of time to put a value on that business. Have you ever tried to buy a business where the owner just didn't know how much money that they made or didn't have any idea of what it was valued at?
It's funny you say that because I was looking at a CPA firm once, and I asked the guy for his tax return. He says, "Well, I haven't really done the tax return. I don't know. Here's a schedule here." And I said, "Well, can I look at your profit and loss in your balance sheet?" "Well, I don't. I have a schedule here and a schedule there." I said, "You don't have a profit and loss, comparative profit and loss, so I can compare your profits over the years and see the recurring nature of it and all this stuff?" I mean, no, I really don't have that. You're a CPA firm. You don't even have adequate financials. Yeah, I have had that happen. I got up and walked out of there because there's no way I'm buying a company where I can't even tell what their EBITDA is. Had I looked, I did later kind of get a sense that he didn't have any EBITDA, and that's why he wasn't going to give it to me, because he knew I was smart and I wouldn't have paid him anything for his business. So there was a great example where I got out of what would have been a really bad deal by knowing what I'm talking about in this video.
Brian, thanks for telling us more about how to value a business.